Thank you for checking out Fieldman's Municipal Market Update. Our data is as of December 18th, 2024. We did that because we had a Federal Reserve meeting in which they decreased the overnight rate by 25 basis points. I think that was widely expected. This is our 56th recording and our last one for 2024. I think we are going to have some changes for you in 2025. We're going to do a little bit of an update. And hopefully you'll find those things helpful. If you have any suggestions to us, now is the time to give them because we can start working that in our conversation. I do believe we have taken every suggestion that we've received and we've incorporated that in the MMU. So thank you for those who have done that. But before we dive in, I just want to give you some general sense of where the market is. And when this week started, I thought, I'm probably going to have a really boring MMU because all I could see out there was the Fed meeting, but a lot happened, and part of it involves the Fed meeting. So if I start, there's a headline on Bloomberg, and it says, Munis plummet after Fed dials back expectations for rate cuts. So the Fed did exactly what everyone expected. They decreased by 25 basis points. But because of the sentiment or because of the direction that they're potentially talking about here, that has disrupted the stock market and also caused interest rates to go up pretty dramatically. So, but there's another thing. There's another thing that's probably impacting things, and it started yesterday, 12/18, when Elon Musk, who is, I'm not sure if he has official capacity with the federal government, but he came out and said that encouraged a no vote on the spending bill. Now, that's really important because if we don't have a spending bill in place by this Friday, which is tomorrow, the government shuts down right before Christmas. And so maybe a combination of those two things are what threw the markets and things into chaos a bit. But let me tell you what it did to rates. So the 10-year U.S. Treasury, which I've told you is one that the 10-year Treasury is something you should monitor if you're trying to get a general gauge of where rates are. On 12/17, the 10-year Treasury is at 4.40. On 12/19, today, 4.56, went up 16 basis points. Pretty big jump. The AAA MMD throughout the curve has gone up somewhere between 15 and 18 basis points. So the 30-year on 12/17 was 377, on 12/19, 394. Now I'm going to show you some numbers, but keep the two of those numbers in mind. But I would keep the 394 because I'm going to show you some data as of the beginning of the month, as you can just see how much that's changed. So before we dive into numbers, just want to give you a general sense of the news that we have out there. And I think this is probably the last week where a lot of people will be working because next week is Christmas. So this slide, we had a ton packed in, and it kind of looks like we packed even more in. So I'm going to break this down, and I think when I break it down, you're going to see it's a little simpler than it looks. The green bars are the Fed funds rate changes. And so you use the guide on the far right vertical axis to give you that gauge. And so if you look on there, you can see the first one in March of 22, that's a 25 basis points. You can see that in the far right. And then if you go over 3 notches, you can see then it went up, they increased rates by 75 basis points. Now that yellow line correlates to that. The yellow line is the aggregate of all the Fed fund rate increases. And so you can see it stair steps upward as the Fed increases rates, and the stair step is steeper when you've had larger rate increases. But now go all the way to far right, you can see where the Fed started with a 50 basis point cut. You can see that big drop, and then they've had 225 basis points after that, and you can see that reflected there. Now, the other thing that I think is important is to look at the 10-year Treasury and how that is reacting, or I wouldn't say just reacting to it, but how that is moving when these rate cuts are taking place. And here you can see, and if we had it extended out through 12/19, you would see it go in the inverse direction as the Fed funds rate. And so that's pretty interesting to someone in my position, is how the market is reacting to that. The other thing I failed to mention is there's a lot of talk about inflation right now too. And as I think I've said to you on the MMU, is inflation is the enemy of a bondholder because it just erodes that real value of the interest payments that they receive. And so there's two things being talked about that are potentially inflationary. One is tariffs, and two is possible deportations and changing the labor force a bit. So it could be done in a way that there is not inflationary effect, but that's probably another item that's weighing on investors. So until there's certainty that those two items would not result in inflation, that likely is having upward pressure on interest rates. Here we're showing you, I've talked a lot about the week of January 3rd, 2022, and that is where economists and people woke up and said the inflation was not just transitory, it is just inflation. And even though the Fed did not increase rates in January, they did in March of that year, things really started to shift. But one thing I want to point out about that is that yield curve, you see how it kind of slopes upward, at least gradually, but it does slope upward. Now to go to our current where rates are, and that is that light green, much flatter. But one thing I want to point out is it was inversed in recent months, and now that seems to be dissipating, where we have more traditional yield curve, even though it is very flat. This chart I always find very interesting. It really gives a summary of kind of how things have gone the month prior. Keep in mind, if you're looking at a month date there, the data is from the month before. So December 2nd is November's data. And you can see rates decreased in November, but they had increased in October when you see that November 1 data. But what I just told you was some other data points, and that 30-year MMD. So December 2nd is at 3.59, and on 12/19 it's at 3.94. That's a substantial increase in a short period of time. So we're likely to have a positive number and change, and positive number means rates are higher, not necessarily positive for our issuer clients. Here's MMD. We give you some data. This tries to give you the MMD going back to 2005. The bar charts represent the range of interest rates for each one of those maturities, years 1 through 30. The green line represents where rates were as of 12/18. And so you can see between years 1 and years 9, there is somewhat of an inversion in the yield curve, just not nearly as dramatic as we've seen before, but you can generally see rates have trended higher. Now, keep in mind though, once again, that rate they see there is 3.79, that is now 3.94. Here's some data, just kind of how things are shaken out over the last several years. You can see, I kind of like the one on the far right and on the top section. You can see volume really did pick up in 2024 from the prior 2 years. And I think that trend is going to continue a bit. One of the things I think will be driving that is you're going to see more refundings. So in 2021-22, rates got so low that we could refinance tax-exempt deal with taxable interest rates. And so what it did was it pulled forward deals that otherwise would have taken place in 2023 and 24. And I think we're getting past that. We have a lot more of just kind of refundings that are popping in the market. Now drop down to the far right there. I think you're seeing some of what I talked about there start to take place. So 2022-23, only 13% of the market were kind of straight refundings. And in 2024, as of the date of this data, you can see there it's already at 17%. Nowhere near what we saw in 19, 20, and 21, but you can see it's more than a little bit more than it has been. Money flowing in and out of the bond funds. And the reason why bond funds are so important is they buy a substantial amount of the bonds. And so green bars means money's flowing in, yellow means money's flowing out. So we do have a good situation where money is flowing into the bond funds on a pretty regular basis. Volume just really picked up for December. We are very, very busy. And you can see there a lot of that was at December 2nd and then even December 9th. Most of them above the weekly averages. Economic data points coming up, and I think another thing that's really important is things really do slow down the back half of the year, and you can see there we have Christmas next week. This just gives you a general trend of how these different MMD, AAA MMDs are trending, and give you a little more perspective than I've given you on some of the other ones. But if you have questions on this, feel free to reach out to us. Now, our final slide is just our registered municipal advisors. I want to thank all of them for another great year. This team works very hard to make sure that we deliver a great result for our clients. So thank you to all our clients for working with us, and also thank you for our team for doing such a great job. Happy holidays. I look forward to presenting to many of you in 2025, also with hopefully an updated presentation. Take care.